In this week's video, we'll review the latest charts and data to help us answer the question, should investors brace for a big drop in October? We'll review the weight of the evidence and try to determine, are we seeing normal and healthy volatility, or are we seeing a significant shift in the appetite for risk? Then we'll shift gears to reference points that can help us monitor the health of the current uptrend and assess probabilities on an ongoing basis. And in the back half of the video, we'll ask and answer, what does a normal drawdown look like? And what does a concerning drawdown look like? On Friday morning, September 26th, the latest inflation data was released in the form of PCE. The initial reaction during the early moments of trading on Friday was favorable, which is not particularly surprising. We've covered charts like this numerous times in recent years. This is technology stocks FTech relative to energy stocks XLE. You can see as market participants became concerned about excessive stimulus and government spending, and ultimately inflation, the ratio started to decline, and then it started to plummet rapidly in January of 2022. So this is what fear of inflation looks like. This is where the S&P 500 bottomed in October of 2022, telling us that fear of inflation, or lack thereof, is pretty important. The ratio bottomed, for the most part, at the exact same time the S&P 500 bottomed in October of 2022. Thus, as we review the weight of the evidence in this week's video, keep in mind we have seen a significant shift on this chart. This is the AWAP line tied to this high back here, the blue line, the AWAP line tied to the October 2022 low. And you can see for now we're above that. That tells us that market participants believe that this scare is in the rearview mirror. The longer we remain above these levels here, the more relevant it becomes. It's also not surprising in the context of this chart and the inflation data that we had on Friday, that following that inflation report, market participants are still expecting the Fed to cut rates again in October, roughly 1 month from now. Also something to keep in mind as you review the charts in the remainder of the video. Tweet on the left side of your screen, center portion of your screen. Both of them are from the Director of Global Macro at Fidelity Investments, a credible source. From the tweets, the leaders of the pack, the Magnificent Seven, continue to lead with their earnings and are not showing signs of excessive valuation. Second tweet, taking a broader lens to the Magnificent Seven and looking at the Nifty 50. My study of the largest 50 stocks shows that we are nowhere near the valuation extremes that were reached during the late 1990s and early 1970s. That's good news for the market. Also noteworthy, as you review the charts that follow, history says that government shutdowns are basically a wash. Sometimes the market goes up, sometimes the market goes down. Government shutdown is a short-term issue. The market typically looks past short-term issues. Study from Ryan Dietrich, center of your screen. A year after 5-month win streaks in the S&P 500, the market was higher 28 out of 30 times, a year later with an average gain of 12.6%. Reminding us, regardless of what happens in the short term, good, bad, or indifferent, our decisions should be based on data, aka the weight of the evidence rather than emotions, and we should also have realistic expectations about how markets operate in the real world. Givebacks are 100% normal and to be expected. It's a daily chart of the S&P 500 index during the session on Thursday, September 25th, 2 p.m. Eastern Time. You can see this is the third consecutive day up here, at least intraday, where the daily chart has pulled back. Thus far, we've come back and we've tagged an upward sloping 20-day moving average. That's the blue moving average in the upper right-hand corner of your screen. If we were to look at the moving average cluster between the 20-day in blue all the way out to the 250-day down here in black, it still has an early stage trend look. Why is that? The faster moving averages are starting to separate, which looks a lot more like a strong trend over here, lower left-hand corner of your screen. But the longer moving averages here are still in a tight cluster, and they're turning up. Wouldn't be unusual when the market does peak at some point, with a significant peak, to have the moving averages look more like this over here in August of 2024. We don't want to make any assumptions about what's going to happen next. During Thursday's session, it looks like this is a normal pullback within the context of an existing uptrend. But we want to look at the weight of the evidence to see, are some significant cracks starting to appear? If we move to a weekly chart of the S&P 500 with numerous momentum indicators in the lower portion of your screen, at this stage we don't really see anything particularly concerning. It's a daily cloud chart for the S&P 500. The present day look, upper right hand corner of your screen, starts to morph into something more like this on the left side of your screen. This is early March of this year. This is the low down here in April of 2025. Concerns would increase, but thus far, this looks a lot like these pullbacks in this region here within the context of the uptrend. In late September, we're still checking all of the bullish boxes on the daily cloud. And if we look at the true strength index in isolation, this is a constructive look here, similar to this region in here, 2012, 2016, 2019, after the COVID low in here, and after momentum had improved following the October 2022 low. It's a weekly cloud chart of the NASDAQ composite. The market has moved a long way since the April low. At some point, some type of give back is going to be part of the equation. You can see as the trend improves, the red span here is just now breaking above the green cloud. Similar to this region back here, the early stages of the rally after the COVID low in 2020. It's also noteworthy, in a similar region here, the market did experience volatility inside the orange box, and it did have two give-backs. At the end of September, on the weekly cloud, still checking all of the bullish boxes. Markets operate in fractals, which means the way we interpret a yearly chart is the same way we would interpret a 1-minute chart. A 5-minute chart, a 30-minute chart, a 60-minute chart, or a daily chart. So let's assume this is a daily chart. If the market had moved sideways for several months and then broken out to the upside, retested that breakout, and then recaptured the breakout levels, we would consider that to be a positive development. Well, that's what we have on the chart of the NASDAQ 100, $NDX, relative to the S&P 500. This peak here is before the dot-com bust. This is the year 2000 here. We've been consolidating near that peak. And right now, it looks like we have a bullish breakout after 20-plus years of consolidation. And notice, since 2023, we've been consolidating above that breakout level after this retest look in 2022. Our interpretation of this chart would change rather dramatically if the ratio moved into this area here, especially if we took out this low. But that hasn't happened yet, and this still looks like a constructive long-term chart, implying that we should keep an open mind about the NASDAQ 100 outperforming the S&P 500 in the coming years. You can pause your video player. This is a very long-term chart of the NYSE Advanced Decline volume line. We've added Bollinger Bands and a long-term moving average, the thick blue line. There's the bearish cross here in the look in 2001 as the dot-com bubble is popping. Similar cross during the financial crisis, rollover look with the Bollinger Bands. And you can see during the bullish periods, we get something that really doesn't look anything like the bearish periods. 2003, 2016, and recently 2024. Moral of the story, this, a breakout above this level over here that's holding, really doesn't look anything like this nor this. S&P 500 equal weight daily, similar to the daily chart of the S&P 500 that we covered earlier. We still have the positive steps, the 3 steps for a probabilistic trend change, including this higher high here relative to this high. And in late September, at this point, we're still trading above an upward sloping 50-day moving average in red and above an upward sloping 75-day moving average in green. If the market decides to backtrack further, this region in here represents an area of possible support. As noted earlier this year, June of 2025 had similar characteristics to this bullish development back here in November of 2023. On the chart of the Dow, or the Dow Jones Industrial Average, we still have a long-term period, multi-month period of consolidation, followed by a bullish breakout and a constructive improving look in the moving average cluster that ranges, in this case, between the 8-day and the 250-day. Similar and improving look on the broad Dow Jones Composite Average, multi-sector Dow Jones Composite Average. Still have a breakout after a long-term period of consolidation. That breakout took place in 2024 here, then we retested it in 2025. And since then, we've improved significantly. And again, we're consolidating up here in the upper right-hand corner of the screen above the prior period of consolidation, this box in here, which is healthy consolidation. Now we're looking at the Dow, or the Dow Jones Industrial Average, relative to the NASDAQ Composite. When the market was concerned about inflation in early 2022, the year of the bear market, eventually the weekly cloud for this ratio ended up batting 5 for 5, checking all of the bullish boxes. In late September of 2025, we are checking 0 bullish boxes. Said another way, we really don't have a negative development in the present day, similar to the negative development that we could see, measure, and put in a model that was present in January of 2022. As noted on X, when the S&P 500 peaked in January of 2022 here, there was already a massive divergence in place here with ARKF, the ARK FinTech Innovation ETF. S&P 500 makes a higher high. ARKF made a discernible lower high. That's not what we have in the present day. Having said that, if you look at the structure of this trend, it wouldn't be surprising if we experience some give back in here. But at this point, this looks like normal volatility within the context of an existing uptrend. You can pause your video player here. The present day, late September 2025, looks very, very similar to these bullish periods annotated on the screen. February of 1983, June of 1995, September of 2003, and February of 2013. NASDAQ Technical Index monthly chart. Contrast the look here. The dot-com bust bubble is bursting. Tight cluster with the moving averages. They're rolling over. We go from a full-bore bullish look to a full-bore bearish look. Contrast all of this with the look that we have in the rearview mirror. An improving look and a bullish breakout after a long period, multi-year period of consolidation. And it looks like we're trying to transform back into a full-bore bullish look rather than moving away from it when the bubble was bursting in 2000 and 2001. Earlier in 2025, in May and June, we noted this turn, this positive turn in NASDAQ new highs minus new lows was similar to this positive turn following the end of the correction in late October of 2023. Since then, good things have happened in this breadth data and in the major indexes. And in late September of 2025, this looks like a convincing and much stronger move than this tentative move that we had in 2024. This, too, would tend to lean towards normal pullbacks within the context of an existing uptrend. Basket of physical commodities, the CRB index relative to the S&P 500. Commodities versus stocks. January of 2022, market participants are concerned about inflation, CPI, interest rates, and Fed policy. Doesn't look anything, not even remotely close to late September 2025, with the ratio printing a new low. Earlier in 2025, we said a good next step in here would be for the Dow Jones Corporate Bond Index to make a new high above this high. We've done that. This too looks like healthy consolidation after a breakout in 2024. When market participants were concerned about inflation in January of 2022 here, IEF, 7 to 10-year U.S. Treasury bonds, in the ETF world, is moving from the upper left to the lower right. We just broke out a consolidation box here that dates back to March of 2022. You can pause your video player here. The Federal Open Market Committee, impacts shorter-term rates. You can see the 2-year Treasury yield was climbing rapidly in 2021 as market participants were becoming concerned about future inflation. And eventually, the 2-year Treasury yield on the weekly cloud is checking all of the bullish boxes. We don't have anything like that in September of 2025. S&P 500 relative to the price of a 10-year Treasury, present day has a constructive and improving look, especially relative to this confused mess in here in 2022 when the S&P 500 was experiencing a bear market. If you know your stock market history, you know the S&P 500 peaked in October of 2007 to kick off the brutal financial crisis bear market. Look at the ratio of XLY to XLP in 2007 and Q1 of 2008. Contrast it with the look in September of 2025. Contrast the concerning breakdown look for XLK, the technology sector ETF, the tech sector for the S&P 500 index. This is Q1 of 2022 here. Contrast that with the bullish breakout that we have, a bullish breakout that's still holding above a multi-month consolidation box in here. That's what we have in September of 2025. See the early stage look down here in Q1 of 2023. Notice the longer term moving averages down here relative to the faster moving averages. And eventually we get some separation as the trend improves. This tight look in here and the fact that it's sloping upward like this tells us to keep an open mind about this rally lasting potentially a long time. During the session on Thursday, September 25th, at roughly 3 p.m. Eastern Time, XLK, very, very close to a full-bore bullish look, which really doesn't look anything like early 2022. Similar theme here. Energy, XLE relative to SPY, January of 2022, really doesn't look anything like September of 2025. Q1 of 2022 really doesn't look anything like September of 2025. This chart, which we've covered for some time, had an improving annotation earlier in 2025. It's not really improving anymore. It's batting 5 for 5 on the monthly cloud. This is what it looks like when the market is peaking in the year 2000, S&P 500 relative to defensive staples SPY divided by XLP. Very similar and plunging look in 2007 and 2008 during the financial crisis bear market. This is the exact same ratio in the present day, breaking out of a period of consolidation that dates back to the peak in the year 2000. The longer a market goes sideways, the bigger the move you can expect to get when you either get a bullish breakout or bearish breakdown. And as we all know, the chart in front of us says bullish breakout. All of this taking place above an upward sloping and improving 50-month moving average. Contrast that with the look of the moving average here in calendar year 2007. In both the September 12th and September 19th videos, we covered numerous breadth signals that were triggered in calendar year 2025. From a longer-term perspective, it's obviously helpful to understand how the stock market performed in the past, looking out 1 year, 2 years, 3 years, 4 years, and 5 years. And from a risk management and psychological perspective, it's also helpful to understand what the max 1-year drawdown looked like in the S&P 500 after each historical signal. Since they're the most relevant, we're focusing in on breadth signals that were triggered recently, either on August 15th of 2025 or September 11th of 2025. And in 29 of the 32 cases, the drawdown was relatively muted. It ended up in this region up here. Or 3 of the signals were triggered before the COVID crash. Thus, if we're using these signals to monitor the health of the current uptrend, concerns would increase the further the S&P 500 hypothetically drops below 6,300. At the end of September, we're trading around 6,600. Thus, if we want to capture what could be extremely satisfying long-term gains, history says we're going to need to tolerate 100% normal and to-be-expected volatility along the way. Thus, if, hypothetically, the emphasis on the word if, the S&P 500 decides to backtrack in late September or in the month of October, as long as the market makes a stand above 6,300, it's relatively easy to remain patient. Concerns would increase if we breach these levels down here around 6,150, even further if we drop below 6,100, 6,000, or approach 5,900. And you can see most of the historical drawdowns in terms of their magnitude would see the present-day market drop back into the 6,400 to 6,300 region. It's also helpful to look at that same region from a different perspective. This is the same type of analysis that we've been covering in recent videos. The dotted lines, green, blue, and red. Simple 200-day moving average, dotted red line. Simple 100-day moving average is the dotted green line, and the 50-day moving average is the dotted blue line. In this instance, we're focusing on volume by price up here, walking forward from the low that was made when the tariff news became less bad in April of 2025. You can see the largest volume by price bar is here, and it coincides with that 6,400 to 6,300 region. That also aligns nicely with a typical maximum drawdown relative to the studies that we covered in the September 12th and September 19th videos. And if we update the math that we've been looking at in recent videos, and this time we look at the closing high earlier this week, if we dropped hypothetically from the closing high on September 22nd was 66.93 down to the 50-day, that would be a retracement or a drawdown on a closing basis of 3.7%. The table shows some of the major reference points that are also represented graphically on your screen. So really anywhere between 64.78 and 58.16, we have data points that can help us assess the probability of good things happening relative to the probability of bad things happening. And all of these reference points would hypothetically become more relevant if the S&P 500 decides to backtrack. So this region right in here with volume by price, this is also near the cluster of the drawdowns that we just covered. Also coincides here, this dotted line is the closing high in February prior to the tariff plunge. And that comes in right around 61.44, and that hypothetically would represent a drawdown of 8.21% from the S&P 500's closing high that was made earlier this week on September 22nd. And conceptually, as we've mentioned in recent videos, if we saw a pullback between 3.7% and even 10.74%, which is down to this purple line, the anchored volume-weighted average price line that's tied to this February closing high here, not shown on your screen. So if we came back to that anchored volume-weighted average price line, tied to the February high, hypothetically, that will be a drawdown of approximately 11% from the September 22nd closing price in the S&P. And we all know a drop between 3.7% and roughly 11% fits in nicely with the historical drawdowns that occurred in the similar regions of the secular trends, the portion between 1958 and 1968, and from 1991 to 1999. There were 16 drawdowns in those secular bull markets in these windows here, greater than 6%. The average drawdown, 11.51%. The median drawdown, 9.62%. And in each case, the market went on to print a higher high. And since we're looking at the volatility profile at similar stages of secular bull markets, it's also helpful to know that as of late September 2025, we really don't have anything in hand that tells us the present-day secular trend is on the ropes. To the contrary, it appears to be alive and well. You can see in the 1958 to 1968 window, all of the drawdowns were eventually followed by higher highs, drawdown and a higher high, drawdown and a higher high. A similar situation walking forward from this low here. You have a drawdown, you eventually make a higher high. You have a drawdown here in 1994, you eventually print a higher high. And that's relevant if you're patient during 100% normal and to be expected drawdowns that occur even within the context of the strongest trends. And that's really the whole point of this exercise. These reference points can help us remain patient during normal give-back periods in the context of an uptrend. All of this also helps us assess the probability of the trend rolling over and flipping from an uptrend to a downtrend. The probability of bad things happening would increase the further we move in this direction. Now, we all know from our account balances that the market has done quite well since these lows back here when the tariff news became less bad in April of 2025. And we also know at some point we're going to have a give-back period. And even since the April low, we've had give-backs. Here's a give-back, give-back, give-back. In each case, those give-backs were followed by higher highs. A drop down to 6,300 says the S&P 500 would fall on a closing basis approximately 6%, which is a normal give-back within the context of a secular bull market. And what potentially could push the market to a higher high after a give-back? Earnings. And the outlook in late September remains favorable. Given what we know today, as of Friday, September 26, 2025, the odds seem to favor normal volatility and normal corrections and/or givebacks within the context of an existing and ongoing uptrend. And if we're going to continue to use the weight of the evidence to properly reassess the probabilities in the coming days and weeks, we all know the only way that we can do that effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.